Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over 5 beaten down stocks that I think could potentially be some good buys. But before getting into this video, I want to talk about why buying stocks that are down doesn't necessarily mean it's a good value. For example, say you had a house that's worth about $1 million and that house is listed for $10 million. If that price gets reduced by 50% to $5 million, it's still worth $1 million, but you'd be paying $5 million. So technically you're still not getting a good deal. And that's what I want to emphasize in this video. Just because a stock falls does not mean that we should still be buying. And that doesn't mean that the company is still a good valuation. And we're going to be getting into some stocks that I truly believe could look like good valuation. And a few of these stocks do look still overvalued today, but I want to get into why they are. So let's get into these 5 stocks, and we're going to be valuing these companies and taking a look at their fundamentals. And before getting into this video, I just want to tell you guys, valuationinvesting.money, my website for stock analysis, is 50% off for the rest of the holidays. So all the way until the end of 2026. So you can get $4 for the first month, only $4 for the first month. Then it's $8 after that. I think it's one of the cheapest out there. I'm pretty sure it is the cheapest stock analysis tool. So if you want to go check it out, click the link in the description or just look up valuationinvesting.money and you can go sign up through Patreon. So with that being said, let's take a look at the first stock. So the first stock that I'm going to be taking a look at is going to be Hims and Hers. So if you've been a fan of this channel before, you have actually known that I've used to own Hims and Hers. I recently sold it. I think Hims and Hers is a decent company. If you don't know what Hims and Hers is a telehealth company, as we can see here, that connects consumers to licensed healthcare professionals in the US, UK, and internationally. And they offer prescriptions and non-prescription health and wellness products. So they can prescribe medication. And the one thing I do like about Hims and Hers is that this company isn't just a telehealth company. They do offer their own products to sell to people, and also it's a subscription-based model. So this is really good for the future. And also recently, this company has been having some issues with their weight loss drugs. They were compounding GLP-1s. If you don't know what that is, GLP-1s is the main ingredient in weight loss drugs. So Hims and Hers was compounding it, which means they can actually specifically make these drugs. The only way they're allowed to is if this certain drug is in technically a shortage. So back then, just over the past few years, these GLP-1 drugs were technically a shortage. However, it is starting to change from not a shortage. So once it's not in a shortage, that technically means that they're not allowed to compound these drugs. So that's potentially going to be hurting this company. And also they had to deal with Novo Nordisk, which was the major leader in weight loss drugs. And that actually got terminated about a year ago. This has really made the stock not do well over the past. So with that being said, taking a look at the market cap, $9 billion market cap. It's a pretty small company. P ratio 75, so that's pretty high, especially compared to the market. So the valuation is very high. Taking a look also, the net cash is a bit bad here. I don't really like this. Negative 500 million. So they have a decent amount of debt, so keep that in mind. And what I like to look at is the financial charts here. Taking a look at the financial charts, Hims and Hers revenue, this revenue looks very good. So the revenue growth is very good for Hims and Hers. The problem here is the EPS. The profit margin has started to decrease as of late, and I don't like that about this company. And I don't like how the EPS is decreasing because of that weight loss drug problem. So keep that in mind. With the 7-step stock analysis, this is the 7 key metrics I like to look at. With the 7 key metrics, we get 4 out of the 7 key metrics as check marks. The 4P ratio is very high, 86, so you're paying a pretty hefty valuation for this company. Shares outstanding increasing, and debt to free cash flow is pretty bad. So it's pretty interesting that, like I said, the total debt has really risen a lot. I'm not sure why that is. You have to do some more research. As of late, this total debt has really skyrocketed. So that could be a concern for investors. With that being said, going to my intrinsic value calculator, let's input some assumptions here for Hims and Hers. So with the bear case, I think this company can grow. Let's just do bear case 10%, base case 20, bullish case 30. I think these could be a bit high numbers just because of the fact that the weight loss drug category is definitely going to be really decelerating and almost going to be non-existent in the future. It's going to be hard for them to start selling that again. For the profit margin, right now it's at 6%. I think let's do bear case 5, base case 10, bullish case 15. I think they can definitely increase in the future. They have a bunch of new things coming up with their drugs. They have menopause drugs, which I think could be huge in other areas in that area for women's health. So I think that could really help this company grow in the future and find another area for this company. For the future P/E ratio, I think 20, let's do 20 for the bear case. Base case, I'm going to do 35, bullish case 50. And for the shares outstanding, they continue to increase shares at about 1 to 3%. So let's just do 3, 2, and 1%. So calculating the intrinsic values here, what we get here, let's see, what we get for the intrinsic values, we get an annual return base case 14%. So from today, it actually looks pretty decent if you believe these base case numbers. If you believe they can increase their profit margin and their revenue does decelerate, this is taking into account that the deceleration of revenue. So they're growing much faster than 20% as of now. So if you think this could happen, this looks like a good buy. And if you think bull case, wow, you should definitely be buying this company if you think that they can grow 30%. So that's what I think for the first stock with Hims and Hers. Now, with the next company I'm going to be looking at, let's take a look at another company that has really been beaten up. And this is going to be Duolingo. If you don't know what Duolingo is, it's basically an app for learning languages. That's basically what they do. It's a pretty interactive app so you can learn languages. And as we can see over the past year, the stock is down 45%. And since basically the summer, this stock has been continuing to fall. And the main reason for this is because of a lot of the AI concerns of this company in the future. If, for example, Meta glasses came out and you could see that they can live translate into your home language. So that is having investors concerned about Duolingo. Honestly, I don't think that is a huge concern. Yes, it definitely could be a very bad catalyst. I don't think that's necessarily going to mean Duolingo is going to go away. And I've actually been really interested in Duolingo because I think people still are going to want to learn how to speak different languages. I don't think just because translations will be perfect, I don't think that's necessarily going to mean people don't want to learn how to speak other languages. And with that being said, Duolingo market cap 8.8 billion. Their price to book looks pretty decent. The price of sales look pretty decent. Looking at this, the price of sales and all these metrics don't look amazing, but compared to their growth rates, this looks actually very good. So the value looks decent. I really like the balance sheet here. The net cash is very good. They have $1 billion in net cash. That is about 12% of their market cap. That's a lot. So that looks good for Duolingo. And look at this revenue growth. Perfect revenue growth here. EPS growth. Very good EPS growth. Everything looks good. The debt is going up. Free cash flow, though, is doing really good. Everything looks very good with this company. The only thing I don't like about this company here is the shares outstanding. As we can see, shares outstanding increasing at 5.8%. I don't really love that about Duolingo. So that's the only thing I don't like about this company is increasing shares that fast. The revenue growth has been good, and I think for the bear case, let's do very conservative numbers. Bear case 8%. Base case, I actually will do, let's do 14%, I think, and then bullish case 20. I think these are fair numbers, and these might be really low. Future profit margin, right now their profit margin's at 40%. So I think for the future, we could potentially definitely see a decrease in the profit margin just for the fact that the AI translations, less people will be willing to pay for Duolingo, but I honestly still think that they're going to have a high profit margin, at least 30% bear case, base case 35, bullish case 40. Now for the future P ratio, I think 20 is good. 35 might be too high. I might just put 30 here and then 40 for the bull case. So that's what I think. Shares outstanding, they're going to increase these shares pretty fast. I think 5, 4, and 3% will be fair. So calculating the intrinsic values for Duolingo here, I get a decent return, base case 13.2%. Right now, would I be buying this company? Not right now, but I'm very interested in this company. It's a very niche industry, and I really like that about this company. I honestly think they have a really good moat, honestly. That's just what I know people are worried about translations and how this is going to affect this company. But I think us humans really have the desire to learn more and want to understand other people without translations. And I think if that is true, and if you believe that in humans, that we innately want to do that, I think this is a good company to buy, and it's a pretty big moat company in the fact that it's a bunch of languages you can learn, a very interactive app that it's fun. I know a lot of people use it, and I think this is a good company to take a look at. But if you are worried about the future for AI, then I would be slightly concerned. But honestly, I'm not too worried about that. I am a little bit, but it's not a huge worry to me that I don't think that this stock should be beaten up this much because of that. Now, going to the next stock, it's going to be a stock that you guys definitely know about, and I definitely take a look at a lot. We're going to take a look at Adobe stock. So Adobe, take a look at the stock price, down 38% for the year. Looking at Adobe, if you don't know what Adobe does, they're a technology company. They mainly have apps like Photoshop, Premiere Pro, that's their main subscription. Also, they have Adobe Acrobat. And the one thing I do like about Adobe is they're vertically integrated. So Adobe looks very good here. The market cap, $135 billion. The PE ratios are very low. So it's trading at a very low valuation. That's what I like about Adobe. Also, the free cash flow yield is very low, or very high. I mean, so this valuation for Adobe is very attractive, especially for how consistently they're growing this company. The thing I don't love is the net cash is negative, but it's not bad at all. Taking a look at the financial charts here, this is what I really like about this company. Consistent revenue growth, pretty consistent EPS growth, total debt's going down, free cash flow is also growing. Everything looks good for Adobe. They're buying back shares. The 7 out of the 7 key metrics for Adobe. This is what I like about Adobe. It's just, are you willing to buy this company, and do you think that in the future that Adobe will be so disrupted by AI? If you don't think so, then I think this is a good time to be buying. So bear case, let's do bear case 7%. Base case, I might do 10. Bullish case 13%. Right now they're growing at about 10% each year, 10 to 11%. I think it's just going to be around there, but honestly, bull case, I definitely could see happening if they really get their Adobe Firefly to work out well and really do well. For the profit margin, right now it's at 30%. Let's put 25% for the bear case. Base case, let's put 29. Bullish case, I'm going to do 33. I think it might decrease, and the biggest worry is AI. Also competition in this space with Canva, with all these other new things coming out with Figma, all these applications for these editing areas, it might have to make them reduce their prices. For the future P ratio, I think a good P ratio would be 18 here. Base case, I'm going to do 22. And then bullish case, let's do 26. Now for the shares outstanding, they're buying back pretty good, about -2% each year. So I'm going to do -2, -3, and -4. They're really buying back a lot of shares lately, and I like that about Adobe. And with the intrinsic value calculator here, as of today, this looks pretty good. 14.5% return base case. If you think that they can grow 10%, if we be a little conservative here, I think 9% is fair. 13.4%. If you think that, like I said, if this company gets under $300, I might have to load up on this company because I don't think AI is going to disrupt it as much as people think. I think the market is being a little bit silly with this company. I think it's definitely worth about $400, but I do need a margin of safety, and that's why I think under 300 I'd be buying this company. That's just what I believe. Now for the next company we're going to be taking a look at. Next company I'm going to be looking at is another favorite of the community, and this is going to be Novo Nordisk. The stock's down 53%. Novo Nordisk, like I said in the beginning of the video, it is similar to Hims and Hers. Not similar, but it's in the same industry, somewhat, not really, but they did have a deal, so I kind of explained what they do. Novo Nordisk is the main diabetes and obesity drug manufacturer, and this stock has been continuing to tank as a result of increased competition in this space. So keep that in mind. Market cap $219 billion. P ratio very low. This is a very low valuation company at 13, so that's good. Free cash flow yield 15.75%, so that's also insanely good for this company. And the dividend yield 3.5%. This company looks very attractive besides the net cash at -10 billion. So taking a look at Novo Nordisk, the 7-step stock analysis, once again, 7 out of the 7 key metrics. This company is growing very well, 30% EPS, 27% revenue. However, it is decelerating, so you have to keep that in mind. With the bear case, I think this company is definitely going to decelerate a lot. This company expects about 8% growth in the next year, but I still think that this could decelerate. But I think there's a large range of where you think this company can go, and that's why I think the stock is tanking, because of the uncertainty. Because On one hand, this company could do very well in the future, could be the leader for obesity drugs. And if they do create that oral pill that will help people lose weight, that will really help their growth. So that could be a very good catalyst for the bull case. But for the bear case, we could see increased competition with Eli Lilly, Pfizer, and all these other companies, and that would really reduce their market share, which will in turn reduce their profit margin and revenue growth. So honestly, I think for this company, I'm gonna do a very large range of values. So revenue growth, 3% bear case. I think very low growth for that. Base case, I might do 8%. Bullish case, for the bullish case, I'm gonna do 13%. So I think that this is fair for this company. Profit margin, I think 25, 30, and then 35 is fair. Right now it's at 33. I do expect this to decrease in the future just as more competition and also reduced drug prices in the US with that recent from Trump's administration saying that they're going to reduce weight loss drugs. Now for the future P ratio here, I'm going to put 12. Base case, I'm going to put 20. Then bullish case, let's do 28. For the shares outstanding, let's say they decrease at 2% each year on average. So that's what I think this company will do. There's going to be a large range of values, so keep in mind. But base case, if you believe they can grow 8%, that's a 17% return. Keep in mind, these calculations do include the dividend because with the net income, that doesn't take into account the dividend paid. So they pay the dividend with that net income. So technically it does take into account the dividend yield. So with the base case though, if you believe they can grow 8%, this looks very good for Novo Nordisk. And the final stock that I'm going to be taking a look at is going to be Chipotle here. Chipotle stock is down 44%. So this stock is doing very bad. And this company has seen a huge reduction in traffic. If you don't know what Chipotle is, it's a restaurant brand, mainly Mexican grill restaurant. So this company in a lot of restaurants as of late have been seeing a really big move down in their stock prices as a result of some weak consumerism and traffic in their stores. Probably a lot of people do complain about the portion sizes compared to how much it is. So with that being said, the market cap of $46 billion. So this company is a pretty big company. $46 billion, P ratio of 26, free cash flow yield 2.47. So this looks pretty decent for the market cap. The market cap looks pretty interesting, but the PE ratio is pretty high, honestly, and the free cash flow yield is very low. So that's not good for this company, especially a company that is starting to that is decreasing comparable store sales, which means in each store, their actual sales are decreasing year over year. The only way they're growing is through expansion, and you don't really like to see that in retail stores or restaurants. You want to see each store also increasing. So that's a bit concerned with this valuation. The net cash also is pretty high, -3 billion. So I don't really love that. Revenue looks okay, 11%, but we can see it is starting to decelerate. The EPS also starting to decelerate. So looking at the SemStep stock analysis though, everything looks pretty good besides the debt to free cash flow. It's a bit high. So with the intrinsic value calculator here, I expect them to decelerate growth in the future. I'm gonna expect 4% growth, bear case, base case 7, bullish case 10. This honestly could even be aggressive for this company. I don't think it's gonna do well in the future. Future profit margin, honestly, let's do 10%. Let's do base case 13, bullish case 16. Future P ratio with the company growing 4%, I expect a 13, maybe 14 P ratio. Base case, let's do 18, bullish case 22. Now for the shares outstanding, they're buying back, let's see how much exactly, 1% a year. So I expect them to continue to buy back at 1% a year. So base case, let's do -1.5%, and then bullish case, let's do 2%. Calculating the intrinsic values here, we can see that we get a pretty bad return with Chipotle, and me personally, I'm definitely staying away from this company. I've said in the past, this company looks pretty overvalued, so I don't really like that about Chipotle, so keep in mind, the base case just doesn't look good. Even bull case, if you think that can happen, it just doesn't look good to me. So like I said at the beginning, there's definitely cases for these companies. Just because they're down doesn't mean you should be buying. And that's why I believe with Chipotle. All these other stocks though definitely are interesting to me. So thank you guys for watching this video. If you want to go, like I said, check out the holiday sale for valuationinvesting.money here. You can get $4 on the first month. So click right here. You can go over to the platform platforms. Sign up through Patreon. Thank you guys for watching and see you.